Welcome to BRAINELM Lab's channel. Here our goal is to make you better aware of personal finance and other money and finance related topics. Today, we're going to run a really important experiment. We're putting dividend income under the microscope to give you a serious reality check on what $100,000 in dividend stocks actually pays you.
You've probably seen them, right? If you spend any time on social media, you get these claims about easily quitting your job, living off passive income from a pretty modest dividend portfolio. And look, it's a super appealing idea, but it's also a dangerous oversimplification. The reality is, well, it's way different from the hype.
So what is the brutal truth? To find out, we have to move past all those flashy headlines and just look at the actual numbers. So let's step into the lab, and we'll break this down together, piece by piece.
Okay, for our experiment, let's start with our principal investment. We'll use a nice round number, $100,000. This is our starting point, our baseline. Now we need to apply a realistic annual yield. I know you see those flashy double-digit yields out there, but a sustainable rate from a portfolio of healthy, stable companies that's much closer to 3%. This number isn't a high-risk gamble. It's a sign of stability.
So what's the bottom line? Well, that $100,000 at a 3% yield gives you an annual payout of just $3,000. If you break that down, it's only $250 a month.
And here it is. This is the core of our reality check. $3,000 a year is nice, for sure, but it is not life-changing income. For most people, that barely covers the grocery bill for a single month. It's a supplement, you see, not a replacement for your job.
And this leads to the question I know you're thinking. Okay, fine. If 3% isn't enough, why not just find companies that pay 8, 10, or even 12%? It really sounds like a simple solution, but this is exactly where so many investors make a huge mistake. This is something we call the high-yield trap. You have to understand that an unusually high dividend yield often isn't a golden opportunity, it's a giant red flag. It can mean the company is in trouble and investors are selling the stock like crazy. That falling price is what artificially pumps up the yield percentage, signaling a huge risk that the dividend is about to get cut.
To really see how this plays out, let's imagine a scenario. Let's meet Sarah. She wants to maximize her passive income, and she wants to do it fast, so she goes hunting for the highest yield she can possibly find. So Sarah finds a company with a super tempting 10% yield, and she invests heavily. For a little while, the income is great, but pretty soon the struggling company announces it just can't afford the payout anymore, and they're forced to cut the dividend entirely. Just like that, Sarah's income stream is gone. And worse, that bad news sends the stock price plummeting and she loses a big chunk of her initial investment. Now, Sarah's story is a cautionary tale, for sure, but it doesn't mean dividend investing itself is a bad strategy. Absolutely not. It just means we need a different approach. Thankfully, there is a much smarter, more sustainable path forward. And that path is called dividend growth investing. See, the focus here isn't on the highest yield today. It's all about the quality of the company. It's about investing in financially healthy businesses that have a long proven history of not just paying a dividend, but consistently increasing that dividend year after year after year. Think of it this way. Chasing high yields is like finding a fruit tree and just eating all the fruit at once. Yeah, it's a nice short-term benefit, but then it's gone. Dividend growth investing, on the other hand, is like planting the seeds from that fruit. It takes patience, no doubt, but it lets you grow an entire orchard that's going to produce a bigger and bigger harvest for years to come.
Now, let's look at the other side of the coin to see this better strategy in action. Let's meet Michael. He decides he's going to follow that plant the seeds approach.
In his first year, Michael's dividend income is small. It starts at that same realistic 3%. But he's invested in strong, growing companies. By year 5, those companies have raised their dividends several times, and his income has grown quite a bit, without him investing another penny. And then, by year 10, the power of compounding has really taken over. His income stream is now a strong, reliable harvest, providing truly substantial passive income.
So here's our key takeaway from today's lab session. If you remember one thing, make it this. The real path to meaningful dividend income isn't about chasing the highest number you can find. The secret is to shift your focus from the highest yield today to the best potential for growth tomorrow. Find quality companies and let them do the growing for you.
And that's our analysis for today. We really hope this reality check helps you approach dividend investing with a clearer, more sustainable strategy. Thank you so much for joining us in the lab.